Let's be honest, taxes aren't just confusing, they feel unfair, especially when you're young, working hard, and trying to get ahead. You finally start making decent money, and just when you think you're getting somewhere, taxes hit like a truck. Where did all that earnings go? And why does it feel like the system is rigged for the rich? If you've ever asked yourself, am I doing something wrong? Or, is there a smarter way to handle this? You're not alone. Most young professionals feel this way. And the truth is, we were never taught how to navigate taxes. We're thrown into a working world with paychecks, W-2s, self-employment gigs, student loans, and no guidebook on how to legally keep more of what we earn. Well, that's what this video is about. Simple, smart, and legal tax hacks for young professionals, not loopholes for billionaires. Not sketchy tricks, just strategies you can start using now to pay less, save more, and keep yourself ahead of the game. First, let's kill a myth. Making more money doesn't automatically mean paying way more in taxes. The US has a progressive tax system, which means your income is taxed in chunks. If you earn $50,000, the first part, say the first $10,000 or so, is taxed at a low rate. Then the next portion is taxed slightly higher, and so on. Only the income that crosses into the next bracket gets taxed at the higher rate. So don't fear earning more. You're not losing as much as you think. Now let's talk paychecks. If you work a job where taxes are withheld automatically, chances are you filled out a form called a W-4. Most people just guess through it. But adjusting your W-4 correctly can mean bigger paychecks now. When you get a huge refund at tax time, that's not extra money. That's just the IRS giving back what was always yours. Taking a closer look at your W-4 means more monthly income in your pocket starting immediately. Still paying student loans? You may be able to deduct up to $2,500 in student loan interest a year from your taxable income. This deduction directly lowers what you owe, and it doesn't require itemizing your taxes. If you're eligible, claiming this could put a few $100s back into your account legally. Let's move to something most young people ignore: retirement accounts. I know saving for retirement feels like thinking 40 years ahead, but investing in a 401k or IRA is also a tax strategy. Here's how. Money you put into a traditional 401k or IRA lowers your taxable income. If your salary is $60,000 and you contribute $5,000 to a 401k, you'll only pay taxes as if you made $55,000. That means smaller tax bills right now, plus a head start on building future wealth. On the flip side, a Roth IRA doesn't give you an immediate deduction, but any money you invest grows tax-free. And when you withdraw it in retirement, you don't owe a cent in taxes. So if you're in a lower income bracket now, a Roth IRA could be your best friend. And if you're one of the millions of young people doing side hustles, freelance gigs, online sales, or contract work, you've just unlocked a new level of tax power. That extra income is taxed differently, but it also opens the door to deducting business expenses. If you use part of your home for work, you may qualify for the home office deduction, buy equipment, software, or even use your car for work. That might be deductible too. The key is tracking your expenses and understanding what counts. You don't need a fancy accountant, just awareness and good records. You are, in the eyes of the IRS, a small business. Coming up, we'll dig into more ways you can legally reduce what you owe, including one credit most people miss, how to turn vacation into a tax deduction, and what to do right now to prepare for next April. All right, so we've covered self-employment, student loans, and retirement accounts, but we're not done yet. Let's look at a few lesser-known hacks that most young professionals never hear about, even though they can make a serious difference in your tax bill. Have you ever heard of the Saver's Credit? Probably not. It's easily one of the most overlooked tax credits for people under 30. If your income is below a certain level, around $36,500 for single filers in 2025, you might qualify just by contributing to a retirement account. And this isn't a deduction, it's a credit, meaning it reduces your actual tax bill dollar for dollar. Depending on your income, you could get up to $1,000 back just for doing what you're already supposed to do, saving for your future. And here's the best part, you can stack it. Contribute to a traditional IRA to lower your taxable income and score a Saver's Credit for the same contribution. Double win. Yet millions of eligible people miss this every year because it's buried in the forms or skipped by popular tax software. Let's talk about health next. Not just fitness, but health savings accounts, or HSAs. If you're under a high deductible health plan, and many young professionals are, you could open an HSA. Contributions Contributions to an HSA are tax deductible, the money grows tax-free, and as long as you spend it on medical expenses, your withdrawals are tax-free too. It's literally one of the few triple tax advantages in the entire U.S. tax code. Use the money now for co-pays, glasses, or prescriptions, or save and invest it for healthcare in your 60s. Either way, it's your money, not the IRS's. Now, for one of the boldest, most exciting hacks, turning parts of your lifestyle into legal write-offs. But before you get carried away, here's the disclaimer. You can't just call your vacation a business trip because you brought a laptop. The IRS is way smarter than that. But if you do have a side hustle or freelance business and you travel specifically for work, many of your travel expenses become deductible. Flights, hotels, even a portion of your meals could qualify. The trip has to have a legitimate business purpose though, like attending a conference, meeting clients, or shooting content, not just sipping cocktails by the beach. Let's say you're a freelance web designer and you decide to attend a design conference in LA. Your ticket, flight, lodging, and meals while attending the actual event can all qualify, as long as they're necessary and related to your business. That's the key. Don't stretch the truth, but if it's legit, don't leave money on the table. Here's another smart move most people only realize when it's too late: tracking charitable donations. Even if you're not donating thousands, small donations add up. Apps like TurboTax and TaxSlayer often miss or undercount them if you don't itemize. But if you gave clothes to Goodwill, donated to a GoFundMe for a verified nonprofit, or gave money to a 501c3 on Venmo, you might be able to deduct it if you're tracking properly. Pro tip: get a receipt from the charity. Even a confirmation email can count. Okay, so maybe you're sitting there thinking, all this is cool, but I don't want to turn into a tax nerd just to save a few $100. That thinking, that's what the system counts on. That most people will never look past the surface. But those small wins stack up. Every legal deduction, deferral, and credit could mean money that stays in your bank account, compounded over time. It's not about beating the system. It's about understanding the rules and actually using them. Because here's the truth. Wealthy people don't just avoid taxes by chance. They invest in financial literacy. They hire pros. They structure their income in ways that give them options. You might not be there yet, but learning what's possible now means you'll be prepared when you are. Let's recap. What are some real actions you can take this year? Review and update your W-4 to match your actual situation. Contribute to a Roth or traditional IRA based on your income bracket. Don't ignore student loan interest deductions. If you're self-employed, track every business-related expense, no matter how small. Explore HSAs. If your health insurance qualifies, look into the Savers credit and claim it if you qualify. Keep records of any trips that are even partially business-related. Track charitable giving and keep digital receipts. These aren't things you have to overhaul your life to do. They're just smarter ways of approaching what you're probably already doing. So take an hour this week, open a spreadsheet, look at your income, Google the forms. Think about where you spent or could have saved last year. The tax code might be complicated, but playing defense with your money doesn't require a finance degree. Start small, start smart, and as your income grows, your financial power grows with it. If you found this video helpful, or if you just realized there's more to your taxes than you thought, hit the like button, drop a comment about which hack surprised you most, and don't forget to subscribe for more no-fluff financial content made for real people like you. Every single dollar you save today is a dollar you control tomorrow. So take control now.